Welcome once again to Mwango Spaces this Wednesday evening in the middle of April. And we just left the earnings season for banks around East Africa. Most of them are reported the financial year 2025 results. And we thought that we should venture into Uganda a little bit to be able to give you a bit of a flavor on what's happening there in the markets. I wanted to bring on board Stanbic Uganda. They're the biggest bank in Uganda, so you can tell us a little bit about how the market, the structure of everything over there. So I'm going to hand over to the CEO to just introduce himself briefly and tell us a bit about himself, and then I'll ask him a few questions after that. Mumba, tell us a bit about yourself and what you do at Stanbic Uganda.
Thanks, Eric. Good evening. As you rightfully introduced me, Eric, from a professional perspective, serving as the CEO of Stanbic Uganda, a role that I've been in for the last 14 months, worked in the Ugandan market for the last 6 years. Prior to that, worked in Botswana. Prior to that, worked in Zambia. So I've been in the banking sector for the last 21 years across multiple markets. To your question and to say, what is my role? I think my role as the steward of the institution is to provide leadership and direction and enablement to my ExCo colleagues and the wider population in terms of colleagues who work for Stanbic Uganda. And ultimately, we are driven by a purpose, which we say Uganda is our home, we drive our growth. So my overall mandate, if you are to summarize, is to ensure that we are connected to that purpose and executing on that purpose by providing a positive impact in every area of our business, in the driving of our business and also the growth of the Ugandan economy. So, Eric, that's the brief introduction that I would give from a professional background. At a personal level, if I may venture into that area, I am a married man blessed with 4 children, 3 adults, and a teenage son, and of course, one lovely wife who's been a key supporter to me and the rest of the family as we've traversed this journey of life. That's my intro, Eric.
Thank you for that lovely introduction. Because you call Uganda your home, and our listeners are mostly guests there. So I want you to introduce them to your home and tell them a bit about Uganda, maybe frame the country in the wider East African region.
So when we say Uganda is our home as an institution, what we are basically saying is that we are connected to the fabric of Uganda. And as a consequence of us being connected to the fabric of Uganda, what that typically means is that Uganda is important to us, and we need to be part of the growth story, part of the solutioning of any challenges and opportunities that the country experiences. So for us as a financial institution, as Stanbic Uganda, being domiciled in Uganda as the largest bank in Uganda, we have a responsibility, first of all, from a financial sector perspective and also from a citizenship perspective. As tenants of this Ugandan market, one of our responsibilities is to ensure that any aspects that border on driving the growth, facilitating trade and payments from an electronic perspective, we participate in that. So as tenants of Uganda, I think our responsibility as a financial institution is to ensure that we provide proof points of that purpose by being relevant and providing financial impact and solutions to enable businesses and individuals to grow. So that is what Uganda being our home means to me and the entire community of standard bankers in Uganda.
So how's the economy like and how's the country like in terms of the banking sector, and where do you fit in that? I know you said that it's your home and you play a key role, but within the banking sector itself, how big are you? Give people a bit of context to that.
Eric, first of all, maybe let me start it from painting flavor in terms of how the economy is structured. First of all, I think to acknowledge the fact that we are most fortunate to have a very well diversified economy, which constitutes about 24% driven by agriculture, 26% by industry, and the balance by services, which is about 50% of the economy size. At the last estimate was at about $60 billion and has been growing at an average of 5 to 6% over the last 5 years. So we're really operating in an environment that has been growth-driven, an environment that has been resilient and responding positively to the various global and local challenges. That is from a macroeconomic perspective view. From a banking sector view, we currently have around 22 registered commercial banks in a market where the population is close to about 50 million Ugandans. And as Stanbic Bank Uganda, we are the number 1 bank. We've been in this market since 1906, but officially as Standard Bank Group, we've been here for the last 35 years. So we are the largest bank in Uganda. We have a branch network of around 83. We have 2,000 employees, close to 700,000 customers. So we are the largest bank by assets, profitability, revenue, and from a returns perspective as well. So that's a bit of context about who we are and as the leading bank in Uganda.
So, right, in the context of the broader Standard Bank Group, could you place yourself where you are in the group, where you see, and that's your relationship to the Uganda, Kenya? I know from my bit of research, I realized Uganda is bigger than Kenya on the size of the bank. Could you place us within the context of the broader Standard Bank Group and how you fit in there?
Also, Eric, important that I also provide some context on how Uganda became a behemoth in East Africa. As I indicated, prior to 1991, operated under a different brand. So the group entered the market in 1991. And at that time, we were not the largest bank in the country. There was a local bank or a national bank known as Uganda Commercial Bank, which we acquired in 2002. And that's what gave us the impetus to leapfrog and become the dominant bank in the market, and something that we've done with pride over the last 35 years. So that is a bit about our history. There's been tremendous growth over the last 35 years that has ensured that we continue to dominate that number one position as we execute on our ever-evolving strategies. That is some additional context on who we are as Uganda. In the wider Standard Bank Group, as Standard Bank Group is the largest bank on the continent by assets and operates in 21 sub-Saharan countries. So what that means that if we exclude South Africa, we are in 20 markets outside of South Africa on the African continent. And these markets are segmented into what we call regions. And each region is overseen by what is called a regional chief executive, whom I report into. So the East African market constitutes about 6 countries. There's Uganda, there's Kenya, Tanzania, Ethiopia, Malawi from a segmentation perspective, and South Sudan. So in the bigger scheme of things, from those 3 regions, the biggest region that we have is West Africa, followed by Central and Southern Africa, and then East Africa. But from a transformation and growth perspective, the fastest growing region that we have within the group outside of South Africa is actually East Africa and West Africa. So we are proud to be part of those growth markets that are adding a lot of value to the group. And in the pecking order, you have said rightfully so that Uganda is bigger than Kenya. Yes, it is. From a contribution and size perspective, we are market leaders where we are, given that history that we've had over the years and the inorganic growth that we invested in many years ago. So that has paid off and means that we are the largest business in this community of 6 East African countries from a group segmentation perspective. So that's how instrumental or big the Ugandan business is in relation to the wider Standard Bank Group. Coupled with that, we are one of the top 4 markets outside of South Africa. And you acquire that status by virtue of the size of the business from a headline earnings contribution perspective, which is one of the key matrices that we are measured by in terms of the success and contribution that we make to the wider group. So a very significant market from a group perspective, very significant market from a regional perspective as well, and also from a local perspective. We are what is called a domestically systematic important bank. From that perspective, it means that any aspects that are critical to the growth of the economy or sectors, we need to be shown to be participating quite strongly in line with our risk appetite and target market criteria. I hope, Eric, that provides some context in terms of who we are as an institution.
Indeed. Now we can move a little bit and discuss strategy. What's your edge as a bank when you look at the key markets that you play in? Could you give our listeners a bit of flavor on the various markets that you play in, where you have competitive edge, and also some of the segments that you have more strength in and perhaps than others?
So I think also to paint some color, I think when you look at a commercial bank, it's important to understand from a market perspective and a segmentation perspective how it operates. I'm sure you're aware you have corporate and investment banks, personal and private banks, and business and commercial banking. And so in our case, how we operate is that our business is segmented. we have what is called the corporate and investment banking business, which is our anchor business. That is the largest business with a segment within our context. Then we have three other businesses, the personal and private banking business, which deals with retail clients and providing solutions to that particular market segment. And then we have what we call the business and commercial banking. What business and commercial banking does is really provide solutions for what would call small and medium-sized enterprises, whose classification and description differs from institution to institution. But overall, that is the way we segment our businesses. We also have a fourth business, which we call the insurance and asset management business, but that's the smallest business and it contributes less than 3% to our overall headline earnings. So it does provide us with an opportunity of diversifying our revenue streams even further. So in the context of the Ugandan business, so we are a fully fledged commercial bank providing the full suite of commercial banking services for our corporate clients and the business and commercial banking clients. That product suite will range from providing debt management products, investment market products, financial markets or risk management products, and work trade and working capital solutions. In addition to that, we also provide local and international payment solutions to our corporate clients. Triangulating that with our business and commercial banking or SME segment, that full suite of products is also available, albeit at a smaller scale in line with the size of the businesses that we service within that particular segment. And of course, the personal and private banking, which services individuals and provides solutions similarly from an unsecured lending perspective or debt product basis, mortgage financing, and also in electronic payment solutions to enable individuals to trade or to make and receive payments in the Ugandan banking sector. So that's in brief color of how we are segmented as a business. So what does that then mean in terms of strategic intent? When we look at who we are as an institution or as a commercial bank, as I indicated, being the leading bank, it means that in all those business segments that I've made reference to, corporate, personal, and commercial banking, it means that we need to be dominant in playing in those particular areas, in providing solutions to our clients in those business segments. At the onset, when I introduced myself and the Ugandan business, one of the things I said was that we have a purpose in Uganda, it being our home and us being tenants, the number one tenants when it comes to the banking sector. We are really premised on driving the growth of the economy of Uganda. And through our positioning, I think it is critical that we are able to demonstrate that through what we call our positive impact framework. And what that simply means is that we should be providing solutions in businesses that are in sectors that are critical to the driving of the economy. And later on, I think I will speak to our positive impact framework and how we balance it out with respect to driving the commercial value and also providing a social responsibility aspect. So our strategy really is premise number one in driving growth, and the priorities that we follow in achieving this growth is to ensure that we focus on number one, driving or transforming client experience. Number two, executing with excellence. And number three, driving sustainable value. And if you break that down further, you will recall that in my introduction, I spoke to the various business segments under which we operate. If I go back to say transforming client experience, what that means is that we need to be exceptional in each of the business segments that we operate in, and we need to ensure that we are driving growth within those business segments. And as a country and being part of a group, we do have parameters and aspirations that we follow in terms of the sort of revenue growth that we should achieve in those particular business segments. And those are things that are published whenever we go to the market to give them an indication that in every business that we operate in, we want to be growing our top line by double digits and growing close to 15% from a top line perspective. There are intricacies that help us determine that. But ultimately, as growth focused business, the desire is to ensure that we are achieving double-digit growth. That is above real growth, as it were, when you take into account, say, your inflation and GDP. Around executing with excellence, that's really about how the service offering that we have. Do we have the right segmentation, which is a positive? Yes. Do we have the right products to provide solutions to our clients? And the answer to that is yes. So that is the thought process that goes into us speaking to that second strategic priority of executing with excellence. And in achieving that execution with excellence, it also has an arm of operational excellence where we bring in efficiency into the way we service our clients. And of course, at the end of it all is the third pillar, which we call driving sustainable value. And this is about really ensuring that growth translates into sustainable value from a returns perspective. And by returns, we are looking at ensuring that you are providing or driving sustainable growth in headline earnings and also providing a shareholder return that is above the cost of equity. So that means typically deriving returns on equity in excess of 20%. So that is how we look at our strategic priorities. And overall, like I said, we triangulate everything back to our overall purpose statement of Uganda being our home and us driving hard growth through having a positive impact in all the key sectors that we operate in, and also in line with our positive impact agenda. Overall, we drive a sector-led strategy that resonates with our purpose and positive impact agenda. I hope, Eric, that provides some color in terms of how we look at strategy, how we look at our role in the Ugandan banking sector and in the economy at large.
Yes, you have. I just wanted to ask, from your experience, having been in other markets around East and I think Southern Africa, as you say, what's the difference about the way Uganda conducts business, especially as regards banking? We know Kenya do like mobile money a lot. So that intersection between banks and mobile money is very critical. From your high-level observation, what are perhaps some of the things that are unique to the Ugandan market that you would maybe take advantage of to build a really good bank as you have?
If I look at it in the context of Uganda, taking it from the top, I think taking a macro view, one of the things that are unique about the Ugandan market is its diversification. I think that strong segmentation of the market between agri, industry, and services makes this economy quite resilient, because if my memory serves me right, in 2020, even in the advent of COVID, this economy grew by 3.5%. And that was in response to the resilience that is synonymous with this particular market. So at a macro level, I think the diversification of the economy is one of the things that I would say is unique to Uganda. Number two, I would say that the markets or the citizens are very entrepreneurial. Statistics tell us that close to 70% of the GDP of Uganda is driven by SMEs, that's small and medium enterprises and individual businesses. So I think that's another unique salient point relating to the Ugandan market that I will amplify. And I think another point that is quite interesting is cash is still king in Uganda. Mobile money has developed quite significantly. Penetration rates are going up, but there's still a number of areas, like trading areas, where cash is still quite heavy in terms of performing transactions. So that's one area that I would want to say is quite different from Kenya, where you can't do any business, make any payment without M-Pesa. So I would say it's a hybrid and very cosmopolitan when it comes to how we manage cash and how we perform electronic transactions. And I must say as well that we have grown quite significantly. There is a lot of interplay between the banks and the mobile money companies. We have seen mobile money subscribers increase exponentially over the last 5 to 10 years. Currently, I think if you look at mobile money users in the Ugandan economy, they're in excess of 35 million. And if you look at the number of banked population, this is close to around 6 million. So you see that between the formal banking sector and the mobile money or fintech sector, there is that gap that shows you that there is a lot of transactions that are being done through mobile money. Once that is happening as well, you still have a certain section of the economy that is still dependent on cash, which obviously the banks have to manage effectively. So those are some of the 3 or so unique features that I would say are there about the Ugandan economy and the banking sector. I think from a regulation point of view, I think we have a very astute regulator in the sense that they're very switched on and very proactive. And I say that with a huge sense of pride and humility as well, to say that the regulator is on the ball in terms of providing counsel, managing monetary policy, to just ensure that there is stability in the financial markets. So it's a very well-regulated market. I think one of the other things that is unique and is a very big selling point for international investors is that we don't have exchange controls in Uganda. You are free to push in your capital at will. You can invest and withdraw your money at will without any form of exchange controls. Obviously, you need to comply with the KYC requirements, such as determining what your source of funds are, where you're taking it to, what you're paying for, and all those good things. But generally, that point of having a free market that is free in the truest sense, where you're able to have control over your capital, I think for me, that is a key selling point in terms of what is unique about the Ugandan banking sector and the Ugandan economy.
In the Kenyan context, M-Pesa is everything here. When you're moving around, M-Pesa is all you need, and that intersection between banks and the mobile money is very critical. So it's good to learn from you on how the Ugandan context is. So I wanted to maybe take a little bit of time for you to take us through the financial year 2025 results. And in that way, you can learn a little bit about the financial performance of the entity itself, and also a little bit more about some of the key numbers that people should pay attention to, including, I think you have a very major target by 2028 on where you want to be as a bank. So let's start from the high level. Let's talk about the profit performance and some of the key drivers that drove that. So it's 23-24% increase in profit after tax. So tell us a bit what drove that and what part of that performance you feel like it's more structural or cyclical in that sense. So take us through the numbers.
I think like you led with the headline and triangulating or reconciling this to our strategic intent in terms of driving sustainable value. That is demonstrated through continued growth in the top line, as I indicated, by double digits. For the year 2025, we delivered exceptional financial performance in the sense that our growth generally from a value perspective and a returns perspective was above average. We were able to deliver a profit growth of 23.6% or rounded off to 24% by delivering a profitability of 591 Ugandan shillings. And then for context of the audience, if you look at the exchange rates, it should be about 1 Ugandan shilling to 30 Kenyan shillings. So it's 1 to 30. So 591 billion is what we delivered in terms of profit after tax. I think in dollar terms, that's about $163 million, just to simplify it for the benefit of their translation differences. This growth was largely underpinned by our top line growth across all our business segments. We were able to generate a revenue growth of 11% on a year-on-year basis, generating revenues of just shy of $400 million, which was an 11% growth from the previous year. And this growth was largely driven by our balance sheet growth. If you look at our loans and advances, we grew our loans and advances by 16% in comparison to the previous year. Our liabilities were up 12.9%. So there was a huge play in terms of the balance sheet driving our growth from a net interest income perspective. We also saw increased transactional activity that saw our non-interest revenue grow 21% on a year-on-year basis. So if you were to ask me what drove the profitability, it's obviously balance sheet growth from a loans and advances perspective. Looking at the numbers, if we looked at growth from an overall sector perspective, we dispersed loans close to 800 billion Ugandan shillings, and I think this constituted almost about 30% of the total loan disbursements in the market. Touch wood, this should be the strongest in terms of the market. Numbers are still being published by the competition, but based on what the details that we have as of now, so far the indications are that we had the strongest loan disbursements in the market to various sectors of the economy that we support, as I alluded to earlier. So loan growth was quite significant in driving this performance. Our liability growth equally was quite incremental and significant in driving this performance on a year-on-year basis. Our transaction volumes were up on a year-on-year basis, driven by increased activity from a trade and debt perspective. So we saw that being quite critical drivers of our overall top-line growth. On the efficiency side, I think costs were well managed as well. Investments were done in our people, resulting in the double-digit growth in our operating costs. But that we've taken as an investment that we are beginning to see the returns for, based on overall strong returns that we delivered. So all this performance from a top-line growth, PAT, and returns perspective, therefore resulted in an overall return on equity of 26.8%. which speaks to the positive outcome that we have realized as an institution in summarizing the performance for Stanbic Uganda Holdings Limited, those were some of the key drivers that drove the performance that we published to the market on the 23rd of March this year.
I want to highlight one thing that is pretty unique about perhaps Stanbic Uganda and also the broader Ugandan market that is not there in the Kenyan market. The NPL ratio is around single digits. What's the magic in Uganda? And what have you learned there that perhaps you can teach here around East Africa and just specifically in Kenya where our average NPL ratio is around 15 to 17% there? What's the magic?
I'll be honest with you is that over the last 21 years that I've been in banking, there are cycles in terms of lending. Sometimes these things could arise from market factors. They could arise from sectoral issues that cause an impact or a negative impact on the overall NPLs. But I think speaking to the Ugandan context, in the year of COVID, our NPLs had jumped to the levels of 5.3% at an industry level. And gradually, as we have learned or taken lessons from sectors that were impacted by COVID, such as education, tourism, as some of the examples of where we picked up learnings, I would just say that learnings have been picked up in terms of certain things to anticipate and also things that you need to consider to insulate yourselves around cycles. And I wouldn't want to say we have a magic wand to say we have gotten it right to ensure that we can never have a calamity in our market. Like I said, sometimes the macro factors or sectoral issues can impact the performance of loans in a sector. There are various issues that come to play that can be drivers. I have not done a deep dive. I am aware that in Kenya, your NPLs are around 17%. I'll need to deepen my understanding of the market context to understand what has driven that. Sometimes regulation as well can impact the performance of certain sectors that inhibits their ability to meet their obligations from a credit perspective. So credit is about going through cycles. I think that would be the fair assessment of how you manage these issues. To bring it home to Stanbic Uganda, some of the levers, obviously there will be levers that are within your control. And the levers that will be in your control is obviously the credit skills that you have in place. We have invested quite a bit in enhancing the talent from a credit risk management perspective. I think that's been quite critical to us being able to manage our portfolio the way we have. We have equally enhanced our credit criteria to ensure that we are more data-driven in terms of the credit decisions that we undertake. And the third aspect we've been able to undertake as an institution as well is investment in technology from a credit origination perspective, a credit monitoring and control perspective. That ensures that there are early warning indicators of trouble coming down the horizon. So those are the things that are within our control. But the macro factors, sectoral issues, regulatory issues, or geopolitical risks that like we are currently experiencing in the Middle East, how those things impact business going forward, your guess is as good as mine. But one of the things that, as you said today, you mentioned that there is pressure in terms of increasing fuel prices. It's not only in Kenya. We have heard in the media from a negative perspective that countries like Mozambique have had significant increases in their oil prices. And if the war continues, I think the global economy will be impacted. I was listening to a news item earlier today whereby I think the IMF was signaling to say that they may need to adjust the global growth forecast from the initial 3.2% that they had talked about earlier to something else. They're bearing in mind the geopolitical risks that are occurring. The war that is happening in the Middle East, if you look at it from a credit risk perspective, as someone who's in the banking sector, I think if there is something that keeps me awake at night is the impact that war will have on Ugandan businesses that we provide credit facilities to. Because there is no doubt that if we see an increase in fuel prices, which we've seen some marginal increase in the fuel price over the last 6 to 8 weeks. But how we remain stable, how we manage that, I think remains to be seen. There's been a lot of talk about the people who are in the agri and manufacturing sectors. The price of fertilizer that is acquired from the Middle East has been going up. The price of wheat is going up. and other input products that we import as sub-Saharan countries are going up. The multiple of all those things and the impact that it has on businesses may result in credit risks materializing in certain sectors, depending on the resilience that is built into various businesses. So that would be my response to the non-performing loans. We are not wizards, Chief. We are just trying our level best and trying to learn from past experiences. And at this point is really just to empathize with our colleagues in the Kenyan banking sector, because I can assure you that the principles and processes that I've spoken to, they're definitely applying that. It must be factors that are not within their control, which are normally structural and independent of their control. That would be my contribution towards that point, Eric. I hope it does provide some color in terms of the difference between Kenya and Uganda.
It does. It's a humility also in terms of banking. Things can move against you in such a way that, especially for things that you have no control about, say, Middle East crisis. I was listening to Jamie Dimon, one of the global bankers that everyone looks up to. I was talking about the issue of being disciplined on credit. There are things that you turn down, of course, you don't finance. So I think that's one thing that also helps NPLs mostly. But also, as you said, the other thing that talks about legacy issues. Some banks in Kenya struggle with legacy NPLs, which are like from 20, 15 years ago. Then that's a key thing also that impacts that. And of course, it's obvious that the issues like the Middle East, you don't know how long this crisis might last. It's always being on the lookout for new sources of risk like that. But sometimes also things that happen that you have no control about, and just the discipline is what helps you get through that. And those are the three things I'm gathering from you, from that response. Am I right in that?
That's a good summary, Eric. Very good summary.
So something else that stood out is the cost-to-income ratio, around 47%. Talk to us a little bit about it, how you're managing costs, how you approach to in terms of digital, to having branches. Do banks in Uganda lean towards digital or more towards having branches also? How do you balance also investing in the future? AI is coming here. Also investing in your people, yourself. How do you do that as you try to manage the cost and at the same time to be able to boost the growth, the top line growth at the end?
You rightfully said, when you are coming up with the cost to income ratio, it's a function of the income and it's also a function of the cost. So the general philosophy that we try to drive as an institution, number one, is to ensure that our top line is growing by double digits. As I indicated to you, the aspiration is to ensure that you're able to at least grow your top line between 10 to 15% on an annual basis, and also manage your costs within inflation. I did mention the fact that we had a double-digit inflation growth in cost growth on a year-on-year basis as a consequence of deliberate investments that we made in our people, from a comp perspective, from a training perspective, just to ensure that we equip them with the relevant skills that are necessary for them to serve our clients effectively. So that is from a philosophical point of view. Investment in technology, as there is no doubt that we are living in the digital age, and investment in technology remains critical to ensuring that we are able to serve our customers. If we look at it in the context of Stanbic Uganda, over 80% of our transactions are done through our digital platforms. The branch network caters for the remaining components. There is also a cultural element where certain individuals are still culturally lean towards visiting a brick and mortar branch. And if I look at our context, I think branches are still significant as a delivery channel, because they not only service retail and personal customers, but they also service SMEs, they also service corporate customers. So from where we sit, for now and the medium term, we still believe that the branch will continue to be a channel of delivery, but efficiency from a profitability perspective, each branch has to be able to sustain its operation, and it ought to be relevant or necessary to the servicing customers in that particular market segment in which we have that offering. So I think from an overall customer delivery point of view or delivery channel point of view, that is how we look at the role of the branch. So it's ensuring that it is delivering or solutioning for clients that have a need in that sector, and also ensuring that it is sustainable by being profitable and generating revenues driven by balance sheet growth and other trade activities that sustain its operations. So that's how we look at it. Investment in people, I think I've touched a bit on that. That remains quite critical. As you would imagine, for every institution, most businesses, the biggest cost that you have is people. Actually, don't look at it as a cost, but I'd like to look at it as the biggest investment because that's the asset that generates the juice, right? So very important that you have colleagues that are well looked after and you do invest in their welfare just to ensure that they are able to live above average lives. Investment in AI as an institution, yes, we have developed an AI strategy. And that strategy is meant to ensure that data becomes cardinal to how we make certain decisions, how we understand customer behaviors. Within our business segments, we do have the use of AI to determine the needs of our customers and just identify new opportunities for us to be able to drive growth through solutioning for our clients. So that's generally how we look at the aspect of the cost, income ratios, efficiency, and driving sustainable growth.
Let's turn a bit to capital allocation and how you think about OPEX, CAPEX and all. One thing that stands out is last year you boosted dividends by 20% at our dividend payout. I think around 1160 billion Ugandan shillings. How do you think about like capital allocation when you generate the revenues and turn them into profits? After that, how do you think about how much should we give to the investors? Do you have a policy around that? So that when the investors are coming to invest, are they looking at Stanbic Uganda as a dividend play? And at the end of the day, talk to us a little bit about your thinking around that.
So Eric, being in the banking sector, all aspects that you've spoken about, capital, liquidity, aspects that are regulated. So you have prescription about the level of capital that you should hold as an institution. You have prescription around the level of liquidity that you should hold as an institution. And as an institution that is focused on driving sustainable value, one of the things that is critical is to be able to continuously pay dividends to shareholders. So it being one of our three strategic pillars, I think it is something that is critical, and being a listed entity as well, you need to demonstrate returns to your shareholders. And the philosophy that we look at when it comes to dividend payment is that for so long as you have sufficient capital, sufficient liquidity, and meet all the regulatory guidelines, you need to pay a certain percentage of your profit as dividends. So what I can say is that you see the payout ratio. I think if you look at the 2024 in relation to 2025, we had a payout of 62% in the previous year, 61% in the current year. So we're quite aggressive in terms of dividend payments. But those dividend payments are guaranteed on the basis of continued profitability and also on our adherence to the regulatory guidelines. So as a regulated financial institution, before you pay a dividend payout in response to the performance of your business, you need to ensure that you are able to demonstrate to the regulator that your payout of a dividend would not necessarily result into a capital breach. So our philosophy overall is to pay a dividend sustainably to the extent that we are able to comply with the regulatory requirement, and also take into account the strategic intent that we have. Because the size of capital, I think when you ask me, one of the benefits or advantages that we have as an institution is the size of our balance sheet. I think in dollar terms, it's a $3 billion plus balance sheet. What that therefore means is that we can literally do any transaction in this economy. Because from a single legal limit, we have a very strong capacity to be able to finance deals of any quantum. Where we are incapacitated, obviously there are options in terms of syndication with other Standard Bank Group entities or with the group. But from a local Stanbic Uganda perspective, I think the sheer size of our balance sheet ensures that we are able to do most of the huge transactions in the market. So that's the thought process that we employ when we look at the distinction between capital, funding, liquidity, and returns. So that's generally the philosophy around dividend payments. But the desire is always to ensure that we reward our shareholders with a decent return to the extent that the business continues to perform and register incremental growth. So you will see that 20% growth of dividend year on year is more or less in tandem with the growth in headline earnings, which was up 23.6% on a year-on-year basis. I hope that gives you some color, Eric.
Very well stated. I want you to move a little bit to your future outlook, and perhaps before we move to the future outlook, tell us a little bit about how you balance generating profits and creating positive impact in your home, as you call it now. Tell us a bit about what you do there. as a responsible citizen and as a responsible person within the home of Uganda, what are you doing there to do good and to do business at the same time?
At the top of the conversation, Eric, I emphasize our purpose statement as a business in Uganda and as a business that is operating across the African continent. I did indicate that our purpose at a local level is that Uganda is our home and we drive our growth. At a continental level, we said Africa is our home and we drive our growth. So in triangulating or reconciling with that purpose, we said, how are we going to deliver on that purpose in our day-to-day activities from a commercial perspective and also from a social perspective? And as a group, about 2 years ago, we came up with what we're calling the Positive Impact Framework. And what the Positive Impact Framework does is bucket our strategic execution into what we call 5 pillars, which are premised on 5 principles. The first one we call financial inclusion. We talk about enterprise growth and job creation, infrastructure, and integrated energy, which is a key strategic pillar in terms of where we play. We talk about climate resilience. Those are commercially driven mainly. And finally, from a corporate philanthropy perspective, we have a corporate citizenship program that focuses on education, health, and environment. And ultimately, when we look at our corporate citizenship agenda, we club it into a philosophy that we call the WYF agenda, which is focusing on women, focusing on youth, focusing on farmers. How we balance all this is, number one, first of all, in all the sectors or all the customers that we serve, they ought to be operating in sectors that drive the Ugandan economy. And that is what informs those aspects of financial inclusion. There will be certain market segments in there, say like when I talk about financial inclusion, we will be solutioning for entities such as cooperative, coming up with product offerings that suit the sort of entities that they are is one of the things that we would do under there. When we talk about enterprise growth and job creation, it speaks to some of the interventions that we have as well in terms of providing financial literacy training to individuals or to SMEs in various areas of the economy through our umbrella company called the Stanbic Incubator, whose sole mandate is to help build capacity for small businesses through the various experience that we have in financial management. And ultimately, as I spoke about the anchor theme of WYF or Women, Youth and Farmers, one of the things that we've set up as an agenda or as a target is to ensure that by 2028, we're able to grow the extension of finance to these particular market segments to the tune of 1 trillion Ugandan shillings. We are on that journey. We are close to around 500 billion as I speak, but the aspiration is to double this by 2028. So ultimately, our positive impact framework has a commercial objective and a social objective. And from the commercial objective, it's got to be tied to those sectors that are impactful in driving the economy and also reconciles with that demographic that we've spoken about of women, youth, and farmers, who are critical constituents of the Ugandan economic sector. So that's what our positive impact agenda is all about and the way it frames the way we do our business as a bank in Uganda.
Before I move to the final question, there's some questions from the audience that have come in. One of them that has come in is a young investor who wants to invest in government bonds, but I think it's talking about political risk being a little bit high in terms of leadership transition and all. I know you can't comment on specific politics and all, but what advice can you give this young man, any other listener who perhaps is paying more attention to politics than to investing? What do you tell them so that they can also be challenged to move from the comfort zone to just investing that money in the market and putting it to play?
I think what an investor should be looking at, by the way, this really sometimes is information, right? So from where we sit from a security perspective, the Uganda is very safe. From a leadership perspective, it's a democratically run country. So if one is to make an investment decision, those are the considerations. From an investor's perspective, one of the key selling points I mentioned earlier, Eric, when you asked me advantages of uniqueness of Uganda relative to a market like Kenya, is a free flow of capital. You can invest and remove your money at will. So taking a medium and long-term view, I think your money is safe because you have control over when you can take it in and out of the market. We have both a primary market for dealing in primary securities and also a secondary market. So if you need advice to that extent, please feel free to contact us. You can contact us through our website. Our numbers are there. And I would encourage you to get in touch with our colleague in the global markets department that would be able to provide advice.
We will share the email on our post as soon as the spaces is done. So let's deal with a few other questions. One is from Will, who's asking that while the NPLs were quite low in the first half of the year, he says they picked up in the second half. Maybe you can speak to that. And then secondly, he's asking if you can refresh their memories in terms of the timeline for Ugandan oil production. So I think you must be a key player there since you're quite big in the market. And perhaps a final question for me is, what are some of the sectors that when you talk to investors, they're pretty excited about when they come to Uganda? A foreigner looking in, I wanted to come to Uganda. What are some of the things that are very interesting that they should pay attention to? One or two things that's top of mind that come to you?
Yes, there was a question to say there was a pickup in NPLs in the second half of the year. That's absolutely true. I think if you look at the evolution of our loan bookings, in the first quarter of last year, we had some timing differences in terms of bringing elephant deals onto the balance sheet. And from the second quarter into the second half of 2025, that is when we had, I think, over 60% of the bookings coming through onto the balance sheet. So as you would know, in line with IFRS requirements, you need to take ECL or we will call them day one losses on any bookings that you take. So that construct really is in response to the increased bookings in terms of loans and advances. And that is why you see that tick up in the second half of the year. So it was in direct response to the increase in the loans and advances book. That's what drove that up. Oil production, I think the authorities are telling us that the target for oil production, we should expect the first oil touch wood in Q4 of 2026. If we are not able to meet that target, which I think no one would want to happen, if there is a delay, the indication is that by Q1 2027, which is next year. That is holding all things constant. I think the caveat I'll put there, Eric, is that we are living in a world of uncertainty. There is currently uncertainty in the global environment. So if there are any dependencies on international investors and local investors as well, that may be impacted by geopolitical risks. That's one of the risks that I want to take into account. But based on information available currently, from the authorities, the Uganda National Oil Company and Petroleum Authority, touch wood Q4 2026. Final point, areas of opportunity in the Ugandan market. We will definitely talk about agriculture, talk about tourism, talk about manufacturing, and of course, you can't ignore the oil and gas sector. I think it is an emerging sector. I think sometimes you can club it under mining. So mining is a sector that is more or less nascent in the market, but does provide great opportunities for growth. Agriculture, tourism, mining, oil and gas are some of the areas that one would consider when investing in Uganda.
One more question, another one from the audience. What advice do you have for young professionals who are starting off? And how did you get to where you are? What are some of maybe key reflections from your professional life that can be implemented in other young professionals' lives also? And on that note, you can also share with us maybe one of the kindest things that perhaps someone has ever done to you in terms of pushing your career forward, or life generally.
When I speak to young people, I think some of the principles that some of us, I think we're Gen X or something, grew with is the values such as discipline is extremely important, hard work is extremely important, getting grounded in terms of developing skills. For example, if you are an accounting professional or a marketing professional who's just graduated, you need to ensure that you learn the principles of work. The principles of work I like to club in 3-4 categories. Those are people skills, leadership skills, money skills, and entrepreneurial skills. It is important for me for one to be grounded, and by grounding I mean you need to get sufficient experience in an area that you want to specialize in. And for me, sufficient experience, there is a reason why graduate programs require one to rotate, say, from 1 to 2 years in various roles at a similar level. So getting grounded, as I think, is important because it ensures you have depth in the area of specialization. So in short, make sure you learn the ways of work, those principles that I spoke about, the aspects of people, leadership, entrepreneurial skills are quite critical for you to develop mastery in an area that you choose to grow in. Finding a mentor, I think mentorship is extremely important because when you are going towards a particular goal, it is important that you speak to mentors who are able to take you through the ropes of what sort of investment, what they had to learn, and the sort of sacrifices that one had to put in for them to achieve what they have. But if there are two key principles that I always emphasize to young people is to say they're not old school. Working hard is not as easy as it sounds. It has to be deliberate. You have to be deliberate about working hard. You have to be deliberate about creating value. And you have to be deliberate about being dependable. In short, if you're looking to excel in your career, make the role of your boss and your colleagues easy so that you are the go-to person whenever anything critical or opportunities arise for you to grow in your career. That is what I can say in the limited time that we have.
Any interesting story from your life about someone maybe doing a kind thing to propel your career or life forward?
Yeah, look, the person that stands out, prior to joining Standard Bank, I used to work for a competitor bank. So around 11 years ago, I used to be a CFO for a business in Zambia. Then I had a boss who was based in South Africa, a lady called Nomsebo. She gave me an opportunity to cross borders, and that opportunity then opened up other opportunities for me to become visible to the group and also become visible when a C opportunity opened up in Uganda. So I always think that that gesture was a kind gesture, not that it was charitable. Yes, I was working hard, but she would have given the opportunity to anyone who was equally as good or better than myself. So if I'm to think of somebody who stands out in my career, that lady Nomsevo was extremely kind to me. And one of my former CEOs, Renette Bandemere, was also quite kind to me because when she asked me about having aspirations of becoming a CEO, she mentored me for a whole 5 years and gave me just immense opportunities to grow and be exposed as a leader, including giving me added responsibilities to break her span of control as a part of my growth journey. So if I'm to think of acts of kindness, I think those two ladies stand out in terms of my career growth. And that is why I also emphasize to say that it is important to have a mentor at an early age that then becomes like your source of reason or your source of wisdom or your fountain of wisdom in helping you navigate your growth aspirations. So that is my comment around people who've been kind to me.
Mumba, you've done excellent today. Thank you so much for your time and just giving us really wise words at the end and definitely taking us through a journey through Uganda and Stanbic Uganda. And so perhaps as you close, you can maybe give 2 or 3 things that you would want people to remember this conversation about. And then there's someone who has poked me a little bit and asked, is Stanbic Uganda able to cross-list so that we can get shared at the NSE at some point? So one, about the cross-listing, and finally just tell us a few things that we should remember.
So the question was, is Stanbic Uganda thinking of cross-listing?
Yes. Or perhaps tell them how they can participate in terms of getting shares.
I see. So the greatest vehicle that you can use, we have a sister company called Stanbic Brokerage Services, which is our sister company. They will be the best vehicles or advisors, in addition to our guys in global markets, to help you make decisions on how to invest in our shares. But Stanbic Brokerage Services, our sister company, should be able to support you make that investment decision. What they should remember, that number one, I think from an economic point of view, Uganda remains a very competitive investment destination because of the strength of the economy, the strength of financial markets, and free capital flow. Stanbic Uganda, dealing with Stanbic Uganda, I think as the largest bank in the country, you are rest assured that you are dealing with an institution that is resilient, that has a sound financial muscle from a capital and liquidity perspective. We have a strong distribution offering. I think from a capability perspective, we have about the best talent that there is in the market in terms of structuring complex transactions and solutioning for you. So if you are to think about banking, think about Stanbic Uganda, because we have the capabilities, product offering, and technology that is able to ensure that your investments are safe, and also you are able to seamlessly execute on your business objectives. So that is what I would say. And finally, I know we are a very strong brand. As the largest bank by assets on the continent, you can have all the confidence that dealing with us, you're dealing with professionals, you're dealing with an entity in which your investment will be safe. And as an investor, you are dealing in a stock or investment that promises to provide you with sustainable returns for the foreseeable future. I would leave it at that, Eric, and thank you for the opportunity to engage with your audience, and hoping that there will be other opportunities when we can engage more on the aspirations of Stanbic Uganda Holdings Limited, where we are trying to focus on transforming client experience, executing with excellence, and driving sustainable value for our shareholders. Thank you.
Thank you so much for your time, and we appreciate your team for making this happen on really short notice. Have a lovely evening.